So the market continues to be a little spooked. Inflation obviously is front and center as usual, and got some news last week that was not ideal. I think in terms of the Fed's plan for reducing rates this year, and in addition to that, of course, we've had an escalation in this war in the Middle East, and so the geopolitical tensions are kind of on the rise here, and so some not so great things happened, and so it wasn't a great week in the markets. But let's talk about the story behind it and dive into the numbers a little bit. So this is your Market in Minutes report. I am Mike Minter, Chief Investment Officer with Financial Synergies, and let's take a look at the actual numbers from last week. So 5-day performance, not good. Dow was down over 2, S&P 1.5, Russell 2000 down 3%, NASDAQ down about 0.5%, and foreign developed stocks down about 1%. So across the board, no surprise, it was a down week, and so we've had a bit of a pullback here in the last few weeks, which is natural in a bull market. You're going to have those from time to time. They are healthy. As much as we like to just go up on an elevator, the market doesn't quite work that way. But again, still looking good for the year. Small caps have kind of fallen back into this negative territory here, so definitely didn't want to see that. But they've struggled. I think we've talked about that numerous times. As an asset class on the whole, they've struggled. But across the board, still in positive territory. NASDAQ still and S&P still firmly up for the year, and in foreign developed stocks as well. So let's turn the corner on that for a minute and talk about rates. So rates did tick up a bit, and they have kind of continued this in the last few weeks. But we've got our 30-year at 4.73, the 10-year at 4.62, the 2-year at 4.95, and our 30-year mortgage rate has continued to kind of tick up a little bit incrementally to 7.48. So let's actually talk about a little bit what's behind the headlines here. So inflation, of course, spooks the markets. So on Wednesday, the March CPI report rattled markets, revealing that inflation accelerated slightly more than expected. It's a very sensitive metric right now for the Fed. They really, really want to see more evidence that we're getting close to their target of 2%, which just not quite seeing that the direction they want to see there. Bond yields rose and stocks retreated in response as investors feared the news could influence the Fed's rate decision. And we've seen over the last few weeks the comments coming out of the Fed. They can kind of be all over the place. Some saying we're still on track, some saying we may not see any rate cuts. So it's kind of there's been mixed messages, to say the least. So the 10-year Treasury yield had its highest intraday jump in 3 years, and so that's what we were seeing on the previous slide. The rates have jumped up a bit. Markets rallied Thursday as investors were encouraged by the producer price index. This is another inflation gauge that the Fed uses, so which measures inflation at the producer level. But unlike CPI, PPI rose less than expected, which sparked a tech-focused rally. Markets opened lower on Friday as investors wrestled with the conflicting inflation reports. So this last part is about what we were just talking about. Fears of an escalating Middle East conflict also weighed on stocks during the week. Concerns about a potential weekend event led some investors to end the week in a risk-off position. So you saw some profit taking and a little bit of a sell-off there. So let's talk about these inflated expectations. So we've had this expectation that we were going to have so many cuts this year. And of course, that's now kind of dwindled a bit. And whether or not we get a rate cut in June, who knows? But minutes from the Fed March meeting published Wednesday showed officials concerned that inflation wasn't slowing down quickly enough toward the Fed's 2% target. But despite sticky inflation, they reiterated their rate cuts were still on the table for the year. Good to hear. And the start of Q1 earnings season reinforced inflation concerns as several leading money center banks, despite many beating expectations, forecasted lower growth for the remainder of 2024, due partly to inflation and higher than expected rates. On Friday, the University of Michigan survey showed consumer sentiment fell last month, and some concluded that the survey confirmed what consumers have been saying, that inflation is still, in our everyday lives, which I think is hard to argue with. You see that everywhere from the grocery store to the gas pump. Inflation's here. So what is on deck for this week? This is a big week for economic data, and we are in full-on earnings season here with a lot of financials and some healthcare and things like that. So big week for news. We have retail sales, business inventories, housing market, Empire State Manufacturing Index on Monday. Tuesday is housing starts and permits and industrial production. Wednesday, EIA petroleum status. Treasury International Capital Beige Book 20-year auction. That 20-year auction is going to be interesting. We'll keep an eye on that one. Thursday, jobless claims, existing home sales, EIA natural gas report, and Philadelphia Fed manufacturing. So companies reporting earnings is big week. So Monday we have Goldman Sachs, Charles Schwab. Tuesday, United Health Group, Johnson & Johnson, Bank of America, Morgan Stanley. Wednesday, Abbott Labs, Prologis, CSX. And Thursday, Netflix, Elevance, Marsh & McLennan, the Blackstone Group. It's a mouthful. There's a lot of stuff going on this week. Friday, P&G, and the American Express Company. So we will keep an eye on all this for you as usual, and we'll report back next Monday. But hope you guys have a fantastic week. Here's our contact information if you wish to get in touch with us. We'd love to talk to you for any reason. Also, hit that subscribe button down below. We'd love to have you get all of our videos as they come out and become a subscriber. Thanks, guys. We'll talk next week.